Somewhere in all this technology and methodology, practice and strategy, it's easy to forget that we're in a free market economy, a free market enterprise, and that much of what we are doing revolves around money, making more of it while saving more of it, while allocating but not wasting it. It's money. And like it or not, money does make the world go around, or at least it drives the engine of humanity. And many IT professionals forget this fact. Why? Well, let me ask you this question. How many CPAs or financial experts do you really know who can configure and manage a frame relay implementation with OSPF and BGP? You get my point? It's not a very common mix of skills. Well, let's check out this mix of skills in this CBT nugget on IT services financial management. In this nugget of the ITIL series on IT services financial management, we're going to look at 5 key knowledge areas. First of all, we'll look at the basic concepts and terminology of IT services financial management, or ITSFM. Then we'll look at different types or categories of costs. We'll look at the goals of ITSFM, as well as the processes and activities that go into this financial service. And then finally, we'll explore some potential pitfalls of IT services financial management. Sound good? All right, let's dive into it. One of the primary goals of this service is to promote a concept in the organization among the IT staff that's typically not very well promoted, and that is cost awareness. At all times, at all points in all the processes, being aware that this hardware and this software and these resources like personnel and time, they cost money, and to be prudent about the acquisition, the allocation, and the usage of these different resources. As we've learned, IT services have to address things like the quality of the service being provided to the customer or to the end user. They also have to look at the cost of these services. However, these first two things, quality of services and cost of services, can often be contradictory. For example, it may cost more money to get better hardware and to get better software and to hire better personnel to deliver the kind of quality that's expected in a service level agreement. So this is a very fine balance between quality and cost. Also tied into this is customer needs. Now, typically, we can identify the customer needs early on in the process, and hopefully there's no big surprises down the line when it comes to costs. But delivering quality and doing it at a cost-effective way for the customer and for the provider can be a tricky balance. When I was a kid, I was raised by my grandparents all the way up through high school and even my first year of college. And these are people that were born out of the Depression. So money management was very important to them. It really was a penny saved is a penny earned around our household. So at a very, very early age, I got put on a budget. I had a certain amount of money from my allowance. I had a certain amount of money that I would get that I would earn from cutting lawns and doing errands and chores. And I had to really budget. And what is a budget? Well, a budget's really just a list, okay? And from an IT service standpoint, we're going to list all the money that our business, our organization, or our business unit is planning on receiving, all the money it plans on paying out, and how it's going to do this over a certain specified period of time. The process of budgeting is an activity. You predict and you control the spending of money. You may actually go through a periodic negotiation cycle between these different parties, between the provider and the customer and the provider and the user, to help you make modifications to existing budgets or to make changes to future budgeting decisions. You'll also look at a day-to-day monitoring and adjusting of your current inflow and outflow. This is the budgeting process. This is one of the basic concepts of IT financial service management. Another concept is that of accounting, and accounting can have a different meaning from an IT standpoint. For example, there's software called AAA software, authentication, authorization, and accounting. And the accounting aspect basically looks at the usage typically of, let's say, network services, and it decides when did a user, for example, start using that resource, when did they stop using that resource, and how long did they use that resource for. That's typically done for billing. When we talk about accounting here, however, we're actually talking about a service strategy process that's responsible for identifying the real costs of delivering our IT services. We're talking about real accounting, like your buddy or your girlfriend who went to school to become an accountant and a CPA. This is actually delivering IT services, comparing these with budgeted costs, and then managing any variances from our budget. This is the literal accounting process. And so we're kind of tying this into IT services here. And more often than not, this process will not be under the umbrella of an IT specialist or a network specialist or a network admin. You will bring in an individual or individuals to be part of your team, part of your committee, maybe somebody from the finance department of your organization to help you with this process. Another key term is that of charging, okay? Charging relates to all of the things that you're going to do to actually bill your customer for the provided services. So this is the actual process of kind of generating an invoice and billing the customer. This is where that other accounting process of AAA services may actually be involved. The charging process is going to determine the objectives of your charging. Okay, so in other words, what are you charging for, as well as the methods for calculating the charges. So you need to have a very powerful and effective accounting system, typically software, that's going to fulfill the needs for all this detailed accounting information, analysis, tuning, and reporting. In a nutshell, charging is simply requiring payment for your IT services. And again, for a business to manage IT service accounting like budgeting, accounting, and charging, you might use something like Peachtree accounting software or MYOB accounting software, maybe some tool from Microsoft. There's quite a few small to medium-sized business accounting software programs out there. And of course, finally, we have what are called costs, and costs are simply the amount of money that you spend on a certain IT service. Help desk, for example, or providing firewall services. The money you spend on a certain activity, or maybe you can say, how much money does this business unit spend? That's the cost. This is your real money costs, including people's time and depreciation. All these things are basic concepts of IT services financial management. But we can't just stop there, because there's all different types of costs or categories of costs. We want to look at these and distinguish these before we go any further and look at the actual process that we're dealing with here. First of all, we have direct costs versus indirect costs. And a direct cost is basically a cost that is related exclusively or specifically to a particular IT service. For example, implementing an IP telephony service or a voice over IP solution. The actual cost of the phones and implementing those phones in your organization. Then you have what are called indirect costs. These are not specifically or uniquely tied to an IT service. This could be, things like desks and supplies, network management support services, administrative costs, like time of using a contractor or time of using a trainer, for example, indirect costs. Typically, when you're going to charge for indirect costs, you'll share the costs between the customers or the different services that the customer is using. Now, you've also got a way to look at cost in the sense of fixed costs versus variable costs. A fixed cost is going to be independent of the volume of production. For example, if you're producing widgets, okay, whether you're producing 10 widgets or 1,000 widgets or 10,000 widgets, you're going to have some basic fixed costs. Investment in hardware, investment in software, investment in the facilities. You may take into consideration things like the monthly or yearly depreciation or interest. These are fixed costs. And even if you stop producing widgets for, let's say, 2 weeks, doesn't matter, your fixed costs are still going to be there. Now, variable costs are costs which are going to change depending upon changes in production or changes in output. For example, personnel. Supplies like printer cartridges, paper, your electricity bills, These costs are variable and they're directly linked with the amount or the volume of service that you're providing. As the production volume increases, then your variable costs will also rise as well. Sometimes they'll rise proportionally, sometimes they'll rise exponentially, depending upon the product and the organization that you're in. Now, you can also look at costs as capital costs versus operational costs. This is another thing that's implemented as well. A capital cost, it looks at the purchase of an asset that's being used for long-term use, like purchasing switches and routers and network appliances, for example. And then you're going to depreciate these costs over a number of years. Maybe you buy a fleet of trucks, for example. So the costs are going to be pointing to capital cost in the form of depreciation instead of the actual purchase price. Operational costs are going to be day-to-day costs that aren't associated with an actual tangible production resource. A operational cost may be things like software maintenance contracts, for example. Licensing is a good example of an operational cost. Maybe paying insurance premiums. So you've got three different types of categories of costs here, and you need to know these for not only your ITIL experience, but for the exam. Direct costs versus indirect costs, and think of some examples from your own work experience. Fixed costs versus variable costs, and capital costs versus operational costs. Now, within these different categories, you have elements, what are called cost elements. And these cost elements are what we actually use to kind of quantify and qualify costs and to go into the budgeting decisions of financial service management. You've got a wide range of costs here. Now, as I go through these different cost elements, I'd like to see you maybe grab a notepad and write down some of the different examples. And you can think of your own of these different cost elements. But the first one is the ECU. This is the equipment cost unit. This would be like a router or a server, disk storage units, printers. Okay, the communication and network hardware, an equipment cost unit. This is all your IT hardware. Then you have an SCU, and this is the software cost unit. This is your system software, operating systems like Windows 2003, for example, Vista, Linux, Unix, whatever you're using. Are you using transaction processing software, database management systems like SQL, for example, Oracle, application development systems, actual applications themselves, software cost unit. These are the direct costs and the indirect costs to keep your systems going. Then you have what's called an OCU. This is the organizational cost unit. This is the direct and indirect personnel cost. These can be fixed or variable. This is going to be things like salaries, bonuses, training, travel costs, expenses, paying contractors and temporary employees. Then you have what's called an ACU. This is an accommodation cost unit. This is all the indirect and direct costs that relate to housing. For example, housing and facilities. Think of facilities, computer rooms, offices, testing rooms, training rooms, air conditioning, all the things that go with your facilities. A TCU is a transfer cost unit, and a transfer cost unit is associated with goods and services that are provided by other departments. In other words, you're transferring and you're allocating internally charges between departments or business units. For example, as I mentioned earlier, in my IT department, I may need to use the resources of an accounting specialist or a CPA from the finance department. Well, perhaps they may have to bill me. Maybe I've got a legal department and they're going to bill my department for services rendered. These are transfer cost units. Finally, we have a CA, or a cost accounting. This is a cost associated with the actual financial management activities themselves, or the IT service financial management, cost accounting. Now that you have a good grasp of some of the terms and some of the definitions of costs as it relates to IT financial management, let's look at the overall goals of this particular IT service. Of course, the goals are to manage your finances properly and reduce the long-term costs. You also want to give IT management, the tools they need to leverage the benefits of good financial management. Determining identifying, classifying, allocating all of the different IT cost structures. IT financial management is going to declare to the stakeholders the added value of information technology and the information infrastructure. Sometimes it's hard to justify to the stakeholders or to upper management why you need to have that wireless implementation, why you need to have voice over IP, why do we need to go out and buy those new Cisco ASA 5500 devices that combine VPN services and firewalls and intrusion prevention systems. So this helps declare the added value of our expenditures. It's going to improve the total cost of ownership and the return on investment of this hardware and software. So in other words, we're going to reduce the total cost of ownership and we're going to enhance our return on investment. Those are two main goals. Also, IT financial services management forces the business or the organization to make the service levels and their costs more visible. In other words, holding you, quote unquote, accountable. Okay, making more visibility for IT outlays. You don't want things seeping through the cracks. It's going to assure senior management and the stakeholders that IT, not it, but information technology, is being well managed and that it's meeting the business needs, which is first and foremost the main goal. Remember, acquiring new hardware and software isn't just for the sake of being cutting edge or bleeding edge to feed the hunger of IT professionals. You know, systems administrators, network administrators, we always want the next best thing, the next fastest, and sometimes it's not justified. So we want to make sure that we're in line with our business needs and goals and the financial realities of our organization. And IT financial management is going to assist the change management process. Why? Because change management is deeply involved with making changes to software and to hardware and to services. So you can see there's this synergy between financial management and change management, because it's financial management that's going to provide the revenue or the monies, the actual monies and other resources to help supplement or create a foundation for our change management process and our change management team. IT financial management is also referred to as cost management or cost control systems. And the goal here, you can see in this diagram how these things work together in synergy. We're working with the service level management aspect of our organization. So SLM is going to feed into IT financial management. In other words, our infrastructure needs, our IT needs, are based on the activities of our business as defined by service level management and our associated service level agreements. What this leads to, first of all, is the first phase where you have IT planning, IT budgeting, and identifying the financial objectives. All of these things work together to support the developing of an investment strategy that gives you flexibility to incorporate newer technologies, cutting edge technologies, while also meeting the bottom line business needs of your organization. You can identify the priorities in the use of our resources. Do we prioritize server needs over database needs, application servers that is? Do we prioritize network infrastructure or bandwidth over security? How do these things work together? Identifying priorities, making sure that all the costs of our IT resources are covered and within budget. And that's how this leads to accounting and cost control mechanisms. The accounting and cost control process, the decisions that we make there are going to lead to how do we charge our customers. What is the fee that we charge? What is the hourly rate that we charge? What is the cost or the pricing structure for the IT services that we provide to the user or the customer? And of course, this is feedback that goes back to the service level of management, and this information is used to formulate service level agreements and contracts with customers, vendors, and strategic partners. And within this process, we've got 4 key financial management activities that relate to IT. That is budgeting, accounting, charging, and reporting. Let's investigate each one of these actions or activities one at a time. Well, earlier I gave you a definition of what a budget is and the budgeting process, but let's talk more about the budgeting aspect of this IT financial management. Budgeting begins by identifying the main elements. What are the things that are actually limiting the growth of our company? Once you do that, you can start to allocate funds to the solutions to grow your company. It may simply be needing to have more sales. It may need to be, increasing the office space or adding new materials. It's the overall planning and managing of the financial activities of your business. And again, this is going to be a short-term and a long-term process, okay? Corporate, strategic, long-term planning from either 1 to 5 years, and then doing some tweaking every quarter, for example. But this should be a long-term financial approach. And you've got budgets for different areas, and we'll talk about this little area right here, but you've got sales and marketing budgets, you've got production budgets, you've got research and development budgets, administrative budgets, cost and investments. And again, this is all based on the type of business that you have. And realize with ITIL, we're not going to talk about specific processes for the sales and marketing department, okay? This is an infrastructure. This is a set of guidelines. It's a framework. So you really have to make this fit your type of business and your organization. Maybe you're just providing an online service, so the costs of production are going to be very minimalized. But your administrative costs may be high. So you want to adjust this on the type of business that you have. Now, I've kind of circled this here. There's two main types of budgeting. So what we call incremental budgeting, and is what we call zero-based budgeting. Incremental budgeting is basically looking at the financial figures from the previous year and using those for the basis of your new budgeting decisions, okay? You basically make adjustments to last year's figures to reflect your expected changes. So it's incremental budgeting. Zero-based budgeting, as you can probably already guess, starts with a blank slate, a clean slate, and that is what we call our zero base. You ignore the past and you take a fresh look at all of your resources and your resource needs in terms of their present costs in your present budget. You have to evaluate every expense, every existing expense, every projected expense, and decide should it be made and what should the cost be. This is a more time-consuming process, and you typically are only going to do this maybe, once every 5 years. Maybe at the beginning of your strategic long-term planning process. Do this every 3 years, every 5 years, the zero-based budgeting process. You may start out with a zero-based budget and then incrementally on a annually or a semi-annually basis do the incremental budgeting. And of course, this is really where we get into this last bullet point. As an organization, you're going to decide what your budget period is going to be. For most organizations, the budget period will be based around the fiscal year or the financial year. And then you may take that fiscal budget period of a year and then subdivide it into months or quarters or 6-week windows, however you want to approach that. So that's the budgeting aspect of IT financial service management. The accounting process is made up of identifying and qualifying the costs and the expenditures of your organization, the outlays. You want to understand that the way that your costs are structured. Again, that goes back to what we talked about earlier. Are you structuring your costs and defining your costs based on fixed versus variable, capital versus operational, direct versus indirect, and how are you categorizing all of your cost units? It means defining those cost units, those cost elements, the equipment cost unit, the software cost unit, the organization cost unit, the OCU, the ACU, the accommodation cost unit or the facilities, the transfer cost unit, those things we looked at earlier. This is really handled in the accounting process. And then you're going to base your cost structure on a service structure. For example, if you're a Cisco organization, Cisco has an infrastructure called the IIN. Well, you might go ahead and use that Cisco IIN infrastructure to base your cost structure upon. You're then going to subdivide these cost units, hardware, software, and so on, based on each one of these categories: personnel costs, hardware costs, software costs, and overhead. So for example, under this category of software, you have to subdivide the software costs into things like groupware, mail and directory services, your business applications, your collaborative applications like Microsoft Office, for example, file services, print services, workstation operating systems, those types of things, network operating systems like Cisco iOS. So you're going to break down these different cost units and subdivide them accordingly. This really has to be done on a granular basis to have a proper accounting of the IT infrastructure. And then your budgets are going to be based on this cost information. It's going to be done probably annually for each cost element and each service. And again, you may initially do a zero-based system, but then you're going to, on a more regular basis, base these budgets on past analysis and growth trends. So, in other words, your budgets in a large company may actually be done subdivided down to, let's say, just the network operating system software level or the collaborative operating system, let's say Microsoft Office, or maybe using Notes, okay? So you can budget at a subdivided level for a large organization to make it a more modular and more manageable approach. Now, I've already defined charging, but remember one thing about charging. Charging your customers, charging your users, external users and customers is one thing, but the process of charging for internal cost or interdepartmental, this is a pretty new development. And internal charging is really an effective tool to encourage the IT resource users to be much more careful and much more discerning about how they use resources, holding them accountable. And also keep in mind that charging for IT services is going to be a lot less effective if you aren't budgeting other areas of your organization. For example, how do departments use the mailroom? How do the departments use catering services? How do they use personnel administration? How do they use HR? How do they use phone services? You see what I'm saying? If you're just going to limit charging to this IT services area in the long run, it's really not going to benefit your organization because you could be bleeding in other areas. For example, the usage of supplies on a departmental basis. So charging is a very valuable tool if used across the board to allow for the careful usage of all of your corporate resources, but here we're focusing on information technology resources. And again, you're going to have a policy, a charge policy, and it should be compatible with your organization's overall financial policy. And the goal of charging is to recover all of the incurred cost of IT business units. In other words, stop the bleeding if it exists. Put a Band-Aid on areas that you've got leakage, okay? So a charging policy should contain several key areas. It should have a process for communication between departments, communication vertically from managers all the way down to customers and users. Making sure that you're informing people about the methodology that's used to calculate costs on a business unit by business unit basis. A policy should also have some built-in pricing flexibility to be able to keep up with the marketplace, to be able to keep up with changes in the price of commodities, for example. You don't want to change these things on a weekly or daily basis, but you have to have some type of pricing flexibility built in to make up for market conditions or industry conditions or even times of emergency where certain costs can go up. You also want to have in your policy some mechanism for what we call notational charging. In other words, you've invoiced the cost, but they aren't necessarily paid for with the exchange of money between hands or even the exchange of resources between departments. You're invoicing it, but it's really just for the basis of doing analysis and future budgeting processes for looking at different costs in your organization. To gain experience, to better understand the process, to look for mistakes in the charging system. So you see, notational charging is kind of a logical invoice without the actual exchange of money or exchange of resources. It's done mostly for the purpose of analysis and planning in the future. Now, there's a wide variety of pricing policies and elements to your pricing policy. These are some things you should probably jot down. You should know these. Cost plus, going rate, target return, and negotiated contract rate. Some good terminology here. For example, cost plus is a pricing policy which is based on charging the cost incurred plus or in addition to a profit margin. For example, the cost plus a certain percentage markup, like a 30% markup. If this is furniture, it would be much higher than that. You've also got what's called going rate. This is a policy for services where there's already a price agreement in place that's been going on historically for a period of time. In other words, it's the going rate. A target return is a pricing policy whose service price was determined in advance, perhaps based on the market rate, for example. And then a negotiated contract rate is a price that's discussed with a customer or a vendor. If a customer needs a new service, then it gets negotiated on a case-by-case basis. Final element or activity of the IT service management process is reporting, and this includes the invoicing process, invoicing and all communication to the customer or the end user. It also involves conducting regular periodic meetings with the customer, perhaps on a monthly basis. And this is all going to be under the umbrella of service level management based on service level agreements. A service level management is going to be reported to, okay, so the reports go to SLM from the financial management process for IT expenditures on a customer by customer basis to communicate the differences in the actual charges based on the estimated charges. Were the actual charges a certain percentage above the estimated charges, or were they substantially below that? That's where you would look for errors, little red flags to go up with problems in the charging process. You'll also report to SLM with the different methods that are used for accounting and charging and any changes that are being made to those particular processes, those methodologies. And you'll want to report to SLM any disputes between customers based on invoices, charges, costs, and what were the solutions to those disputes. All of these things under the umbrella of IT service financial management reporting. As we finish up this nugget movie, let's talk about some of the possible pitfalls of IT service financial management. And the first one here being the concept that I alluded to earlier on in this nugget movie, and that is the fact that on a large scale, IT personnel are typically not very familiar with the process of monitoring, of calculating, and charging costs for IT services. It's one thing for them to understand the cost of hardware and software and licensing and to kind of be in that loop. But once it gets down to what do we actually charge a customer for this service for this period of time, and look at the allocation of resources and try to build in profit margin, that's typically an area where you don't see a lot of expertise. That's one of the reasons why the ITIL exists, to kind of give you an awakening as IT personnel that this is something that could really be in your responsibility. And how do you become a valuable member of the team without going out and getting, an accounting degree and becoming a CPA? This also, it requires substantial non-IT information, and it may be up to you as an ITIL professional to go out and get that experience and to gain that knowledge. It's hard to find people that have this kind of dual expertise. If they do, typically they're going to be in high demand. They may end up actually becoming a CIO, a Chief Information Officer of an organization, or some other higher level management. Also, this IT service financial management process is very difficult to accomplish if the corporate strategy of your organization and the objectives of information technology and information systems aren't formalized via a definitive written policy, and if the goals aren't in line and have a fundamental synergy. And because of all these factors I've mentioned, it's very common to find a lot of non-cooperation between, let's say, the IT department, research and development, the back-end developers and programmers, and the financial side of the organization, okay, the finance department and the accounting department. I've seen this in my experience for working for large corporations. And what ends up happening is once it gets time for that company to be sold off or merged or bought from another company, a lot of these problems start to come to the surface as people come in and start doing their auditing and doing their evaluations of the value of the company and the value of what resources are available. You start to see this breakdown in communication and non-cooperation come to the surface, and it causes huge issues. Sometimes an entire deal to purchase a company or to merge a company may go down in flames because of all these pitfalls that have kind of been bubbling under the surface. So this lack of commitment from the management in IT service financial management can trickle down all the way through the organization. I misspelled commitment here, but again, I don't have expertise in all areas. All right. So those are some of the possible pitfalls. And again, this is a huge area and one that to develop expertise in the IT service financial management area takes a wide range of deep and involved skill sets, including accounting, understanding cost structures, understanding business, as well as information technology. In this CBT nugget on IT services financial management, we covered 5 key areas. First of all, we looked at some basic concepts and key terminology. We looked at several different categories or types of costs. Then, the goals of ITSFM, processes and activities related to ITSFM, and I just gave you some possible pitfalls. I hope this CBT nugget has been informative for you. I want to thank you for viewing. We'll see you in the next movie.